Hey everyone, I'm going to jump on a bandwagon a bit and talk about what I think happened with GameStop. Now, I know all the outlets have covered this topic exhaustively, but I wasn't satisfied with their explanation because they kind of just talk about how there was a forum called Wall Street Bets on Reddit, and people jumped on it to try to take down this hedge fund and cause a short squeeze, and it snowballed. But I think there's a little bit more to it than that, so I wanted to give a more thoughtful and nuanced explanation as to why I think underlying reasons why the stock went from $20 to like over $300. So I think what's at the heart of the short squeeze is the popularization of options trading. So as you can see in 2020, options trading exploded. It's at least a third, maybe even double what it was a few years ago. And that's obviously being popularized by platforms like Robinhood or Webull. That just allows like retail investors to buy options. And you might be wondering, oh, what's the big deal about options? Why does that cause short squeezes like what we saw in GameStop? And I'll explain why. So first of all, a little bit about options. So options have been around for thousands of years, and it's actually a very intuitive thing to understand. So, for example, let's say you're an ancient merchant who you think you might need to buy some sheep, maybe in the next 6 months. So you talk to a shepherd, and you go, "Hey, can I pay you a little bit of money and reserve the right to buy some sheep from you anytime in the next 6 months?" And if the shepherd goes, "Okay, yeah, you can pay me a little bit for that right for me to sell you sheep," then together they've just created what's called a call option. So it's a very simple, kind of intuitive concept. And it wasn't until like the 70s that people standardized it and started to trade options because they came up with a way to value options, and that's what's known as the Black-Scholes model. And all of this is kind of, boring and too much detail. But what's important to understand is, in my example, an option is you get to pay a little bit of money to reserve a lot of stuff. In the prior case, it was you pay a little bit of money to reserve a lot of sheep. And today you can pay a little bit of money to reserve a lot of stock. So options, as Black and Scholes figured out, is essentially a levered long position in the case of a call, or a levered short position if you're buying a put. And I'll illustrate this with an options chain I just pulled off of a platform. And you can see this is the options chain for Amazon expiring next week. So everyone knows Amazon is a pretty expensive stock. It's trading at like over $3,200. And if you were to buy 100 shares of Amazon stock, how much would that cost you? That would cost you $320,000, like $350,000. But you can also buy an option on Amazon stock expiring next week at, let's say, $3,900, which is, like 20% higher than what it is today. But not that far-fetched, right? For how much? $500. You can reserve the right to buy 100 shares of Amazon stock that would normally cost you $320,000 for the measly sum of $500. And therein lies the leverage feature of options, okay? And why does that cause the short squeeze? Well, a lot of people, instead of buying GameStop stock, which would push up the price slowly, what they bought is GameStop call options, and they bought them in low deltas, very out of the money, and they bought a ton of them. It was important to understand why that causes short squeeze is because when you buy the call option, someone is holding a risk of your call option, and that's usually a bank, right, a market maker. And what the bank has to do then is they have to go out and purchase the amount of stock equal to the delta of that option. So essentially, if you're interested in the financial mathematics of it, it's the call options equal to the borrowing plus purchasing delta of the underlying stock. So let's back to the real world. if you bought that call option for Amazon for $500, it has a delta of 4. So what the bank is going to do is they're going to go and buy 4 shares of Amazon. Okay, that's very important. And if a lot of people on Reddit went and bought a bunch of options, well, the bank's going to go and buy 4 shares of Amazon a ton of times, except because they bought a lot of shares of Amazon, that's going to push the stock of Amazon up, right? And you'll notice in the option chain, what happens when the stock goes up, the delta also keeps going up as well. So, you know that guy, the bank that you bought the option from earlier, that only had to buy 4 shares of Amazon. Well, now when the stock went up, maybe they have to buy 20 shares of Amazon. Okay, so they have to buy another 15 shares to what's called delta hedge themselves. Okay, and because they have to do that, you can tell how there's kind of a self-reinforcing, self-fulfilling snowball effect. As there's more call buying leading to the shares going up, there's more delta hedging done by the banks, which essentially is buying more shares, and that causes the share to go up again, and they have to delta hedge more until what happened with GameStop is if you bought like a $20 call on GameStop and maybe you bought a $100 call on GameStop, the delta was like 1, so the bank only had to buy 1 share to hedge themselves, and the GameStop went to 100, then suddenly the delta became 50 and they had to buy 50 shares. So it's a snowballing effect. It's a vicious cycle that is all kind of, the catalyst is just tiny bits of call positioning creates like a cascading butterfly effect that causes this short squeeze. It's actually pretty fascinating. The second kind of driver, I think, kind of a lesser driver, is that unlike hedge funds and investment managers in the past, the new breed of hedge funds, I wouldn't say new, but the quant hedge funds these days don't really, a lot of them don't invest in a company based on how much cash flow the company generates, how good of a business the underlying business is. They use what's called algorithmic trading. So they use essentially computer programs, and a lot of these algorithms are trend following. So when you're trading on Robinhood, you notice it's free. Well, that's because Robinhood sold your activity to like one of these quant hedge funds, and the quant hedge funds would basically see what you're trying to do, and they would front run you. So they would do what you're trying to do before you, so that you pay a little bit more. Okay, so the quant hedge funds obviously have a lot of money, and they use these momentum signals and trend following signals, and that also creates additional level of buying because they're doing what the retail investors are doing to make money as well. Okay, and the third reason why I think what happened with GameStop happened is that it is typically when these types of things happen and people realize, well, yeah, but GameStop was trading at like $4. It's not that great of a business because all their stores are closed and people aren't really buying games from brick and mortar anymore. But so maybe I should try to like short it because I know the business isn't that great. Well, if you try to do that, you're going to have to pay a lot of money. So when you short a share, you're essentially borrowing shares you don't have, right? And how much does it cost to short GameStop? Well, a few days ago, it cost as high as 83% per year to short GameStop. What does that mean? That means if you were to short GameStop, you have to pay an annualized interest of 83%. Even today, it's come down a lot, but it's still 33%. You know what your high interest credit card charges? Like 24%. So this is like payday loan, pawn shop kind of interest rates. You gotta pay these incredibly. Think about like an interest rate of 83% in a zero interest environment just to short GameStop. So that's like, even if I wanted to short GameStop, I'm not going to do it because it's incredibly expensive from a short borrow perspective to short the stock, right? So that discourages shorts, and then you have all these options buying and all these quant hedge funds jumping in on the long side. obviously that's going to create some massive butterfly effect that triggers the short squeeze. Okay, so now let's talk about a little bit about Melvin Capital. And the narrative out there, like all the are saying that these hedge funds had taken these huge short positions in GameStop that they had to unwind. Well, boy, I looked at Melvin Capital's 13F and their latest, and turns out they didn't really have a big put position in GameStop. Okay, they only had $55 million. Now to me, like but it was recently disclosed they lost close to $3 billion. So how did they lose $3 billion when their position was $55 million in puts? What they must have done, because if they just bought the puts, then they wouldn't have lost more than $55 million. But what they must have done is they either sold puts or they went naked short, and that trade really went against them. So they probably saw GameStop going up, and they're like, fundamentally, hey, the stock can't go up, 100%. So they probably sold some call options on it, or they just started naked shorting the stock, and that came back and bit them. And additionally, all their other positions were being targeted as well. So that's what caused their fund to go from $12 billion down to 10 billion. So billions of dollars of losses. It's quite staggering considering their position was only $55 million. I also want to talk about it's kind of hindsight 2020, but the mistake that Melvin Capital made is that in this environment, it's really dangerous to short a stock like GameStop, because GameStop, I was looking at their income statement, and they're not really a company that's in danger of running out of money or being bankrupt, okay? Because they still have hundreds of $millions on their balance sheet. Their cash flows are kind of flat. They're not generating cash, but they're not losing a lot of cash either. Also, they had $4 billion, or they had $4 billion in sales. $6 billion in sales last year, and $8 billion before that. So their sales have gone down a lot, but why would you short a company with a market cap of just a few $1 billion when they still have billions of dollars in sales? There are companies out there that have no sales that are worth billions of dollars, and there are companies out there like American Airlines that lose billions of dollars. Like GameStop doesn't even lose that much money. So I think hindsight 2020, it's kind of a little bit of a dangerous short, especially in this environment, because the government has been so supportive, the Fed has been so supportive of even companies that are much, much worse of GameStop by propping up, the bond markets, so that even companies like American Airlines that lose billions of dollars are able to sustain themselves by borrowing more money, right? So obviously that came back and bit Melvin Capital. I think this will be a very expensive lesson for them. But to say that it was just a bunch of Redditors who jumped on a bandwagon is, I think, a bit of a simplistic explanation. I think options were at the heart of it, compounded by the quant hedge funds and then the impossibly high stock borrow rates that led to what I think happened with GameStop.